Well, stocks rebounded a touch last week, and the S&P starts the new trading week on the front foot as well, as the dollar's recent declines also take a little bit of a pause for breath amid a lack of protectionist rhetoric from the White House, and as a bonanza of central bank decisions have been well digested by market participants. This week, focus should remain on trade and geopolitics as well, amid what is a relatively quiet data docket outside of the UK, where we have the latest CPI and retail sales figures due, as well as a focus on fiscal policy, with the Chancellor delivering the spring statement on Wednesday. Plenty for myself and Ryan Littlestone to discuss on the trade-off this week. Without further ado, let's get on with the show. Well, given it's taken me 5 minutes and 3 attempts to do the intro to the show this week, I'm going to throw it straight over to my good friend, Ryan Littlestone from Forexo Live and Forex Analytics. Ryan, I guess things can only get better.
I hope so, mate. I was nearly off popping down the pub while you did the intro another 50 times. But we got there in the end, or you got there in the end. So onwards and upwards. It can only get better from here.
Fingers crossed. Anyway, I'm really not entirely sure what was going on there, but yeah, hopefully I've got my teeth in now and stopped tripping over my words. Anyway, it was an interesting week for markets last week. A little bit risk on, stocks higher, the dollar lower, and 5 central bank decisions where I guess nothing was really too surprising, was it?
Yes and no. Yes and no. I'm going to talk about the central banks in a little while, but there were some interesting tidbits to take from the 6 central banks that we got last week.
See, we're still playing that numbers game, even though Ryan Littlestone can't actually work an economic calendar because the Bank Seco is this week rather than last week, as he was going on about in last week's episode. In any case, we can discuss our diaries off air. Let's get into Topical Thunder and work out exactly what's going on in those markets. So, however many central bank decisions there were last week, I think the FOMC was naturally the highlight. And I've got to say, it was nice to get a little bit of normality for a couple of hours on Wednesday evening last week. We had the soothing, dulcet tones of Chair Powell to make us momentarily forget all of the nonsense that's been coming out of the Oval Office over the last 8 weeks or so. Markets were really hoping for that normality, and it's exactly what arrived. The Fed really not wanting to rock the boat at all, holding the Fed funds rate steady at between 4.25% and 4.5% in what was a unanimous vote, and issuing what was effectively a carbon copy of the statement they issued after the March meeting. There was an omission of the line that risks around the dual mandate were roughly in balance, but Chair Powell flagging that that was more just clearing up the language and not meant to send any sort of policy signal. The latest round of economic projections were also pretty much bang in line with expectations, although, of course, conviction in those is relatively low and the uncertainty around them incredibly high, given the ever-changing nature of trade policy in the United States. The committee did nudge their GDP growth forecasts mildly lower and revised their inflation path marginally higher. They'll continue to see PCE falling to 2% well before the end of the forecast horizon. Just on that, there are people out there saying that the Fed were forecasting stagflation. They really weren't. They're pointing to economic growth of as near as makes no difference, 2% over the next 3 years. If anyone can find the stag in that, then maybe let me know down in the comments below. In any case, in reaction to those new forecasts, the median dot across the entire forecast horizon was unchanged. The first time we've seen that since all the way back in December of 2020, with the committee again forecasting 50 basis points worth of cuts both this year and next, and seeing the longer run rate remaining at 3%. We did mention on last week's show that the issue of the balance sheet was the potential wild card, and so it proved, with the Fed deciding to dramatically slow the pace of quantitative tightening, slashing the Treasury redemption cap to $5 billion per month from a prior $25 billion. For all intents and purposes, balance sheet runoff is basically over at this point. The reason why I think they've kept a low cap rather than just ending it altogether is it stops the Fed from being a net buyer of treasuries, which is a little bit optically difficult and hard to communicate. It's easier just to let basically next to nothing kind of drip off the balance sheet on a monthly basis. In terms of Chair Powell, very much sticking to the script at the press conference, really playing everything he could with a straight bat. Policy's in a good place. They're not in any hurry to adjust rates. And realistically, there's not a lot else that Powell can say, as we were discussing on last Thursday on the Flow Show, your morning program, Ryan. And I think, to be honest, the market implications of what the Fed had to say were pretty limited, really. Maybe you could argue that the tweak to QT is a boost for treasuries at the longer end of the curve, although clearly we haven't seen that to start the new trading week. And I guess it's just a reminder that in the equity complex, at least, there is no Fed put, because frankly there can't be when inflation is going to remain above target for the next year or so.
Yeah, it's not often you get central banks taking a back seat, if you like, to the rest of the news that we get, but that's exactly what we've got with the Fed. Same as pretty much everyone else. They've got all this uncertainty, particularly coming from the US themselves. They don't know what's going to happen with trade policy. They don't know what that means for inflation. They have their suspicions, but otherwise they're in the dark as much as the rest of us are. And we got exactly what we expected. The dot squeezed up a bit. No real change though. 2 cuts this year, 2 cuts next year, and some of the more extremist hawks and doves just bringing their dots a bit further lower, further higher, depending on what side they were. QT, yeah, it was either going to be this meeting or one of the next meetings, so that wasn't really a shock, as you say. But then we come down to the market reaction, and I was looking at euro dollar over the event, and really didn't do an awful lot. And here we are.
I was going to say, what reaction?
Yeah, exactly. But even non-reactions tell you something about the story, and it just shows you that the market really wasn't that bothered about what the Fed got up to. We did see a bit of movement in dollar yen on that QT stuff, but really it didn't last too long. But back to euro dollar, yeah, we're turning around this 108.30 70 level. Now this is a zone I have on my chart, and I've had on my chart for years. It really is a big pivotal zone, and the fact that we couldn't really move much around it over the Fed just shows you that we're not quite ready to make a move away from this zone. We've had this rally since March. It's still holding. It needs further upside, but central banks really aren't the driver, because we come through that, the ECB, and the Fed and everything else, and we still can't really move away from this zone. If we do move away from this zone, it does bring you some big, huge moves. As you can see, when we broke below it way back sort of December, all the way down to 102, and when we were above it, all the way up to 112. So it's a level worth watching anyway for this pair.
It is, yeah. Let's not talk about downside too much, because I've got a lunch riding on 110 and we've just broken below the 108 figure. So, yeah, I'm not best pleased about that, I must admit. The last thing I would say on the Fed, just before we move on to some of the other policy announcements last week, and I think most people who watch this show would know by now that I am actually quite a big fan of Jay Powell. I think he's done a bloody brilliant job, certainly since COVID. A little bit shaky at the start of his tenure, but has really, really grown into a very, very accomplished Fed chair. I thought it was incredibly refreshing that Powell was standing there last week, basically, and the nub of what he was saying was, we know as little as everyone else about what's going on. The Fed are being very open and honest and saying, there is all of this uncertainty. We're going to do the best we can to deal with risks on either side of the mandate, but having any degree of sort of clarity and a concrete view is folly at this point. And I think it was refreshing that we heard that, as opposed to a central banker who stood up and would just, almost try and blag their way out of it, which I would imagine the market wouldn't have received particularly well. So, yeah, I thought Powell did a very, very good job last week. And of course, he's only got about 14 months or so left in the job now. But anyway, there were 4 other G10 central bank decisions last week. So shall we get into those?
Yes, we shall. Well, I begrudgingly agree with what you're saying about Powell. As a trader, I would prefer a complete nutcase in the job, then we can get a bit of volatility to trade. But yeah, so be careful what you wish for sometimes. But yeah, let's look at the other 5 central banks that we had out last week, because I think it's worth running a rule over what happened. The S&P cut by 25 as expected, and they showed no indication that they were finished, and indeed sounded pretty bearish about things overall. So could they be the first central bank to get rates back to zero? Obviously, they're on a much lower bar than everyone else in terms of how high they got rates in the first place. The Riksbank, they stayed unchanged, 2.25%, and are expected to do so for the foreseeable future. The Bank of England, they stayed unchanged and proved once again that they are worried about everything and completely impotent when it comes to doing anything about it. We had people who voted for 50 basis point cuts last meeting, moving back to vote for none, and one who voted for 50 last time only wanted a 25 this time. Oh, here comes the hand. Here comes the hand. Go on.
Well, if you read the Pepperstone Bank of England preview, you would have been expecting Catherine Mann to vote for rates to remain unchanged. But, I'll give myself a pat on the back.
Okay, yeah, no one else is going to make, but go on, you can have that one. I'll give you that one. We had people moving from 25s to none. Now, I will concede another point to you that we had a chat about last week, that I might be being a bit overly harsh on them, as they are in the same guessing game regarding US policy as every other central bank, and they also have the misfortune of having to deal with a completely incompetent statistics bureau who can't seem to produce an ounce of correct data. So you raised that point, and I sort of disagree with it on the Flow Show last week, but I do concede that point to you. So look, you can give yourself another pat on the back if you want for that one.
I will, actually. There we go. But actually, on that, sorry to interrupt you again, but before we move on, the ONS have actually got worse, because obviously it's been since middle of 2023 that we haven't had any accurate jobs data in the UK. About 10 days or so ago, they said they couldn't produce any trade numbers. And on Friday morning, very early on a Friday morning, which makes me suspicious they're trying to sweep this under the carpet, they said that they're now unable to produce accurate PPI, producer price index figures. So, I mean, at this point, I'm genuinely at the stage where I don't think we can really trust any UK data to be reliable, because, what other sort of skeletons are lurking that the ONS just haven't actually managed to find yet?
Well, they've managed to cover it. Oh, they've covered jobs, they've covered inflation, and they've covered GDP. So, we've got a GDP report out on Friday. I dread to think what that's going to look like, and who knows? But
it won't be anywhere near accurate. We can guarantee that.
I think I might get my dartboard out and guess the number with that. But anyway, moving back to the topic in hand, central banks. I think overall, probably the most important meeting for markets was the Bank of Japan, who sounded pretty upbeat on the wage front, and that inflation progress is continuing. All the while, they're still going to remain very, very cautious. I think they might have set up a hike for one of the next two meetings. Maybe April is going to be really live on the cards for that. So that was a little bit of a shift, and there was a couple of comments over the weekend, overnight, from Bank of Japan members, Deputy Governor Uchida and Ueda, saying that they will look to normalise policy if their outcomes are likely to be achieved. That's a little subtle shift from waiting for their outcomes to be achieved to likely to be achieved. So again, there's a little bit of a hawkish tilt I noted overnight. Then from the rest, we had the surprise Turkish central bank deciding to hike rates to 46% from 42.5% after their political turmoil there. And we had the SARB on hold at 7.5%, and Mexico surprisingly moving their meeting to this week from last week.
I don't think they moved their meeting. I think you just can't read your diary, mate. That's the problem with that one.
It was definitely on a calendar when I did my notes Sunday. So I won't name names because,
probably best not. I don't want our lawyers to get involved. I think that's a very, very good summary. The developments in Turkey last week, obviously a bit of a tourist in that area personally, but just a reminder that Erdogan can go a little bit crazy every now and again, just as people think things are stable, then all of a sudden they're not. I thought the BOJ was interesting, that language tweak that we saw to start this week. Again, I think the Fed have probably done them a bit of a favour by sitting on the sidelines and saying that they're not in a rush to cut. It just keeps that door ajar for the BOJ to be able to continue tightening. And again, everything is kind of in line for their outlook to actually come to fruition. Inflation is up near 4%. Earnings growth is up near 5%. If you look at the Rengo wage talks that have been going on in recent weeks. So you would expect them to be delivering further tightening in relatively short order. I guess the interesting one really is the SNB. Although they didn't say it explicitly, I would imagine that they're going to try as hard as they damn well can to avoid going back to zero or even into negative territory again. Of course, they're never going to rule it out publicly, but I wouldn't be surprised if exchange rate intervention increasingly becomes their kind of policy tool of choice. And of course, that then runs the risk of upsetting a certain orange man in the White House.
And, as Jordan proved, they don't give a monkey's what he thinks over there regarding intervention. They got slapped on the list before, the intervention list by the US. They do is it a biannual or annual report? I think there's one coming out in April.
Yeah, it's twice a year, I think. Yeah.
Yeah, so we got one due shortly, but the last time they got put on the list, Jordan turned around and said, "Well, we don't give two monkeys really, so jog on." So I expect the same again.
I do kind of respect that in a way. Just, put us on whatever list you want. We're still going to do it. Fair play to him. In any case, let's move on from monetary policy and have a look at fiscal policy, because joy of joys, it is the spring statement here in the UK this week. Chancellor Rachel Reeves due up at the dispatch box Wednesday lunchtime after Prime Minister's questions, so probably about 12:30 London time for those of you who want to sit down with your popcorn and watch it. The first thing I would say is, who on earth scheduled this? I know we discussed this last Thursday, but you've got the spring statement sandwiched between two gilt auctions on the Tuesday and the Thursday, and the latest UK inflation data, which is out on Wednesday morning. So someone at the Treasury has had a little bit of a shocker with that one, I think. In any case, I think in terms of the statement itself, a little bit of framing is important, because if you go back to, well, probably about 9 months ago now, when the Labour government were first elected, one of the first things Rachel Reeves did was pledge to have one major fiscal event a year, and that would be the budget in the autumn. The spring statement was basically going to be a sort of 10-minute job to stand up and say whether or not the OBR think that their forecasts are still accurate and whether the fiscal rules would continue to be met. Since October, though, things have clearly changed quite considerably. Back then, Rachel Reeves left herself £9.9 billion worth of headroom. We have had next to no economic growth, and we have had a significant sell-off in gilts since then. Yields have moved higher across the curve, which, as I think everyone will probably know by now, has eroded that £9.9 billion worth of headroom and some more, leaving a shortfall of between 15 and 20 billion that Rachel Reeves now needs to plug. And as a result, she's going to need to announce some new policy, which of course was never the intention in any case. That new policy, though, is likely to be focused firmly on spending cuts. Reporting in advance of the spring statement indicates that tax rises, or well, I was going to say or tax cuts, but let's be honest, tax rises are going to wait until the budget in the autumn. So Rachel Reeves is likely to deliver somewhere around £15 billion worth of spending cuts, and that would restore headroom to where it was in October. That 15 billion will probably come, about a third of which will be shaved off the benefits bill, so about 5 billion, and everything else is just going to come from slashing government department budgets across Whitehall. It is worth noting, though, that if you go back in history, pre-COVID, the £10 billion worth of headroom is only about a third of the average headroom that we had before the pandemic. And I think this is a real problem, which I'll get onto in a moment. The first thing I do just want to cover very quickly is that the market will also focus very, very closely on the gilt issuance remit, which sounds technical, but effectively it's just the amount of gilts that will be issued. Just over 300 billion is the expectation, and also where they will be issued across the curve. Will it be more at the front end, or will it be more further out the curve? Expectations are that we're going to see a little bit of a pivot towards the front end. I think there's three things, though, that I have in mind here, and I think three problems for Rachel Reeves. The first is that the forecasts and the fiscal headroom and basically her entire statement will be out of date by the time she delivers it. In fact, it is already out of date. And the reason for that is because the OBR took their little snapshot of where gilt yields were right at the start of February. And yields are now about 20 basis points or so higher across the curve since they took that snapshot. So the forecasts basically aren't worth the paper that they're written on, and you probably need to take 3 or 4 billion off whatever headroom figure is actually published due to the rate sensitivity of the UK public finances. The second is that 10 billion quid of headroom, assuming that's roughly the number that she leaves herself, is still very, very narrow. And as we saw 6 months ago, a minor economic shock or a lack of economic growth, a move higher in yields, or really any kind of adverse scenario compared to the OBR's baseline expectation. And what do you know? We're back in a hole. We have no fiscal headroom. The rules are about to be broken, and the Chancellor's got to come back for even more fiscal tightening, whether that be revenue raising or even more spending cuts in the autumn, which, let's be honest, seems almost inevitable at this stage. And the third thing I would say is that, frankly, no matter what Rachel Reeves has to say this week, I think she's already lost the confidence of the vast majority of market participants. And once that's done, it's very, very hard to win it back. And when you consider that and the near inevitability that manifesto pledges are going to have to be broken in order for the fiscal rules to be met, and that a chancellor with no credibility can't change the fiscal rules because you lose credibility even more, I think her days are probably numbered at this point, aren't they?
Yeah, I hope so. But that's a different story. I won't get into the politics on this show. Where do you start with this one? Between the OBR, the Office of Bodge Responsibility, and the ONS, the Office of No Statistics, they're better off playing pin the tail on the donkey as far as getting their numbers right. I've never seen the OBR get a forecast right in ever. So that's one thing aside. I think taking it down to a more trading level, shall we say, if you're not from the UK and you're not listening to the super nuts of this, the nuts and bolts, welfare cuts and all that sort of thing, you've got to take it really that this is going to be another confidence exercise for the market and for investors. If they don't like what she's selling, we're going to see a similar effect to what we saw after the budget. There'll be gilt yields going higher and the pound going lower. So I'm expecting, and I said, I think it was last week or before, that this could be a mini Truss Kwarteng moment in terms of market confidence for what comes from this fiscal noise. And if that happens, then we're going to see some big moves in the pound. So you need to at least be aware that there is big risk for the quid. On the other side of things, really, I'm looking at euro sterling as far as my sort of weapon of choice for this one, because I think it's the cleanest pound pair to look at. You haven't got the volatility of the dollar in cable, and you haven't got the volatility of the yen in guppy, as we call it. So I'm looking at this one. I'm already a little bit long, i.e. short the pound on this one, because I don't see anything positive coming from that. It'll be a complete surprise if we do. Never going to rule it out, but I think on balance, I can't see anything good coming from this. The only caveat I'll offer to that is that she has dialed things down a little bit since, over the last couple of weeks. She agreed now with her cabinet the package that she's going to put forward. She was at odds with over half of those members over what she would do, so she's dialed that down a bit. And there's also been some other sort of headlines and can kicks, like you mentioned, the tax moves that are being kicked to August or to the next budget, main budget. So she has sort of backed down on a few things, but if she comes out with her, I'm doing this and, to hell with it, then the market's going to take a very, very dim view of it.
Indeed. Yeah, I think Wednesday afternoon could be a little bit spicy, I think. The pubs in the city could be quite busy when the gilt market closes. Let me put it that way, because it could be quite an interesting afternoon. And like you say, I think good news is going to be in incredibly short supply. I think that's been cut as well. In any case, let's move on to
just before we move on. I just want to highlight back to that euro sterling chart, because we are sort of sitting in a little bit of a middling range at the moment around this sort of 83, 60, 80 area. And it could be the case that whatever happens, if it's good news, we could be down at towards 0.82s. If it's bad news, we could be right up at the 85. So that's the sort of range I'm looking at, and how much the pound might move over this event, just to make you aware. But now you can move on, mate.
If it's good news, maybe pigs will start flying as well. Right, let's move on to the other bits and bobs that are happening this week.
Yeah, I'll have to dig that picture out I've got of you with pigs flying past in the window.
Yeah. I forgot about that.
Get that one out of the vault, I think. Speaking of hopium, we've got a lot of data coming up today, and today or this week rather, and just start sort of European side of things, because the ECE, or according to some ECB members, there are yet some signs of green shoots appearing, but I think we played this game last year and it didn't come to anything. Germany will be looking for more hopium from this 500 billion investment fund that they dreamt up, and that seeps into the data. So we had PMI data yesterday, because we filmed this on a Monday, so you see it on a Tuesday. So France data, they still look crap, basically. They had both metrics still in the negative. Germany saw a minor improvement.
Mate.
I have to call it as I see it, mate. Germany saw a mild improvement to their manufacturing number, but services did pull back a bit, and certainly nothing in that data telegraphed that there's any optimism about this government spending. Tuesday, we get the IFO survey from Germany, which is another private survey, sentiment survey. And that, again, might show some optimism about this spending. But as we saw with the zoo last week, there wasn't really much in there, and it didn't exactly blow the doors off on that front either. So aside from the political saga we've just spoken about in the UK, we do have some big UK data. Wednesday, we have CPI data, again, for whatever it's worth, from the ONS, and PPI data. Both CPI and the core number are expected to come down a pip to 2.9 and 3.6% respectively. Friday, we see retail sales from the UK and a Q4 GDP revision. Now, eyes will be on whether we can keep this boost that we got in January in retail sales of 1.7%, or it's going to give back more than the minus 0.3% expected. And talking to GDP, we may just be about to close off Q1, but a softer Q4 number, even though it's a revision, might just highlight how much work Rachel Reeves has got to do to get the economy going. So it might be just in focus, given that we've just had her speaking on the Wednesday. Then we start getting some flash inflation data from Europe, starting with France and Spain. So that'll be something for ECB watchers.
Brilliant slip there.
Exactly. Lucky it was a polite one. In the US, it's not overly busy. We get some house price data and home sales on Tuesday, durable goods on Wednesday. Again, we get some final Q4 data on Thursday, which will all be rear view mirror stuff. God, blimey, I'm struggling now. But we also get PCE data and the Michigan final, which stirred up a bit of a hornet's nest last time it dropped the flash number. And on top of all that, we've got month end and quarter end in the mix too, and heading towards those tariff deadlines. So plenty to look forward to on the data front.
Yes, indeed. I'm not sure look forward to is quite the language I would use, but plenty to deal with, shall we say. I think end of month, end of quarter, obviously just consider where markets have traded in Q1 in the equity space. Big move higher in Europe. Also, even in the FTSE, I think we're up about 5% year to date. And obviously in Asia as well, China, Hong Kong have been flying. The US and Japan have been underperforming. If there's some rebalancing needing to go on there, it doesn't take a genius to work out at face value exactly what that may look like. In terms of other bits and bobs, as you mentioned, I wouldn't get overly excited about the UK retail sales. Obviously, we did have that big increase in January, but that was the first month-on-month rise that we saw in sales since all the way back in August of last year. So very much long overdue. And I think the UK consumer is still pretty concerned about everything that's going on a sort of macroeconomic front, particularly as the economy slows and the labour market loosens. Inflation, it's not going to be pretty. I don't think it's going to be a game changer for the BOE. They've been and gone, and we've got another print anyway before the May Bank of England meeting. So they can kind of shrug that one off by and large. The PMIs, as you said, a little bit better than expected on the services front here in the UK. The manufacturing number was terrible, and in Europe they really didn't tell us anything we didn't know already. And I guess just lastly on that German sentiment data, I mean, you'd bloody well hope that sentiment has started to increase when you've just spent €500 billion or announced you're going to spend €500 billion. If that doesn't get people to be more optimistic, then I don't know what would.
No, exactly. But as I say, we didn't see that in the zoo data. It was just marginal effect. So it looks like we're well over that news. But going back to the UK, yeah, the retail sales isn't important in its own. But I think when you're looking through the lens of what Reeves might come up with, if the pound's in a bad mood after that, then any poor data is just going to add more fuel to that fire.
Absolutely. Well, I can tell you for one thing, I'm not sure about the mood the pound will be in, but I can guarantee you that I'll be in a bad mood after that. That is pretty much a given.
I want to know when you're in a good mood, mate.
I don't know. I can't remember either, to be honest.
Probably last time I saw one.
Yeah, again, I can't remember when that was. So long ago. Right, let's move on to our plays of the day. Right, I'm going to bring a little bit more misery, I'm afraid, because I'm going into the fixed income space this week. I'll keep things relatively short and sweet. Obviously, as we've said, it's the spring statement this week. I think, to be honest with you, where gilts head next is almost entirely out of the hands of Rachel Reeves. And what's concerning is the fact that we've seen this continued rise, 20, 25 basis points or so from the yield lows that we saw in mid-February. And that's despite treasuries in particular having actually rallied over that period. So clearly gilts are a bit unloved once again, and it's tough to imagine that changing this week as the Chancellor delivers what is going to be, as we discussed, an out-of-date forecast that barely restores fiscal headroom against what is an incredibly fragile market, and sentiment is very, very dire indeed. You wonder whether it could be a little bit of a sort of worst of all worlds scenario at this moment in time. And to be completely honest, I find it very, very difficult to advocate for anything other than being short gilts right here, particularly if we get a grim CPI number on Wednesday as well. If you get hot CPI Wednesday morning and then Reeves makes a pig's ear of it at lunchtime, how long is it before we get to 5% on that 10-year? I think we might be measuring it in the space of hours rather than days if all of that comes to fruition. But yeah, in short, I can't see the market finding much love for gilts in the short term. Ryan, I would assume from the pair you've chosen that we're going to be talking tariffs here.
Oh, yes, mate. You are very observant today, aren't you? Yes, definitely talking about tariffs, seeing as the topic title is called Ready for Tariff Tantrum 3.
Well, I hadn't seen that. That hadn't come up.
Oh, hasn't got? There you go. It's there now. There you go. But yeah, no, spot on again. Give yourself another pat on the back. That's a hat trick, mate. A hat trick of pats on the back. That's it for 2025. We're counting down to yet another tariff deadline, and already we've had sources stories saying that they're going to be dumbed down yet again. Obviously, we're potentially pending a Trump denial on that. So I'm looking at dollar CAD again, selling another possible tantrum rally up towards the top of my zone, which is up to the 44, 60, 70 area. Obviously, as you can see there from the chart, Tantrum 1 and Tantrum 2, you've got to allow for possible extensions and overshoots, and I'll be doing that like we did on the last two deadlines. I think there's potentially going to be less volatility for any of those types of moves this time, as we've been here before twice now, and as you can see by those reactions on the chart, the last deadline had less volatility than the first. So I'm looking for any bad news in that run-up or negativity to the top of my zone to maybe scale in some shorts.
Indeed. Two things I would add to that. Firstly is on the issue of the Canadian dollar, if anyone is trading it, bear in mind elections, 28th of April, the unreliable boyfriend against a man whose name I haven't learnt to pronounce yet. And secondly, on the tariff front is we have just had a post from President Trump, who has decided that today it's going to be Venezuela who are forced to pay an additional tariff of 25% on any and all trade they do with our country. And that tariff will take place from the 2nd of April. So yeah, we will see what happens on that front. In any case, while we all go and work that out, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Slow Live and Forex Analytics for joining me and trying to make sense of whatever the hell is going on out there at this moment in time. And thank you also to our producer, Kyriakos, for making us look somewhat sensible in trying to make sense of everything that's going on and bringing this together as brilliantly as always. Hopefully you've enjoyed the show. If you have, drop a like on the video. Do leave a comment as well. Let us know how you're trading the markets, your thoughts on what's going on, and of course, if there's any topics that you would like us to discuss in next week's episode. And that is, of course, when we will be back with another episode of The Trade-Off. In the meantime, thank you very much indeed for watching. Goodbye for now.